Well, thanks for joining me today. My name is Cahan. I'm the U.S. Portfolio Strategist at Empirical Research Partners. In today's module, we're going to take a look at how fundamental investors can use quantitative tools to help them do their job. And what I mean by that is really help establish some base level odds on what works and doesn't work in picking stocks. Here at Empirical, we've been designing tools for fundamental investors for a couple of decades now. So what I'll take you through here is in real-time use with our clients, which are many of the major money managers around the world, both hedge funds as well as long-only investors. And so the tools I'm going to show you are real-world tools, and they're in use every day with our clients. The agenda for our course is laid out here, and I'm going to start with the very basics, and that is, what is a factor? Now, for some of you that have some background in quantitative analysis, perhaps through your course of study or in practical use, this might be a little bit repetitive, but please bear with me because I want to establish some of the ground rules. Then in Module 2, we'll talk about fundamentals and how they shape factor performance. I think one of the dangers of quant investing is the tendency to think of factors as kind of entities or personalities in their own right, but really they're just manifestations of something broader that's usually going on either behaviorally or in the underlying economics in the economy. And so we need to understand why things work. Just because something works doesn't mean it's going to keep working. And I think that's particularly true now in the age of AI, where there's a huge amount of data, a huge amount of processing power. It's very easy to find spurious statistical patterns. And so we want to make sure that we have an understanding for why things work, and importantly, whether they'll keep working going forward. The third module is going to look at specific events that can impact stocks. Which ones should we watch out for? And most importantly, which ones have historically led to positive future returns? One of the really important aspects of what we'll talk about in this course is Module 4, and that is, when should we use which tool? That's half the battle. Not every tool works all the time, and we need to understand when is the broader market and macro environment conducive to one factor or tool versus another. We think that's a really important thing to understand, and it helps us put some spin on the ball and make sure that we're using the right equipment at a particular point in time. And then finally, we'll put it all together in a very practical way. And the use case that we'll study is how to avoid stocks that ultimately fail or losers. That's one of the best use of quant tools. So all of the modules that I'll take you through are building up to ultimately what is a real world model that we've been using for 20 plus years here at Empirical. And again, our clients have been using it over that time. It has a very good track record, and I'll explain some of the basics of how we get there. So thanks again for joining us. Let's go ahead and dive into Module 1. And as I mentioned, the first thing we want to think about is just what is a factor? A factor is kind of the building blocks of a systematic toolbox. And so we want to have a good understanding of firstly what a factor is, but then more importantly, which ones actually work. And so we'll start there. So the easiest way to think about a factor is just think of it as a ranking of stocks. And I'm going to start with a very basic factor that many of you will have come across, of course, in either the academic literature or just day-to-day use, and that is the price-to-book ratio. So this is a very basic valuation factor. It's how much am I paying to buy each dollar of book value in the company. And the higher that ratio, kind of the more expensive the company is in some statistical sense. So with this factor, what we can do is we can take all the stocks and rank them by this price to book ratio, right? Such that the expensive stocks, the high price to book ratios are up the top, and down at the bottom are the cheaper stocks or the low price to book ratios. And then what we're interested in is how do those stocks perform going forward? And that's what we're trying to capture in this chart here. So you'll see a lot of charts like this in our course over the next few hours. What we're doing here is we're taking those stocks ranked by price to book and we're breaking them up into quintiles. So the cheapest 20% of stocks on this price to book ratio are in the left-hand bar, and the most expensive 20% are in the right-hand bar. Now, what the bars are showing you is the relative performance of those stocks over the following year. And so those in the left-hand bar historically over about the last 70 years have outperformed by about 2 percentage points per year relative to the market. And those in the most expensive quintile on the right here, they've underperformed by maybe 75 to 100 basis points. And you can see that the stocks that are somewhere in the middle have kind of monotonically performed commensurate with their ranking. And so this is a very simple but effective way of looking at, has a particular factor predicted future returns? And in this case, it has, right? If I just bought the basket of cheaper stocks based on this price to book ratio, again, those in the cheapest quintile on the left here, that has been an outperforming strategy over the last 70 years or so. So that's a plausible candidate for a factor, right? That's a starting point. The problem is, it's not so simple in real life. It never is. Here I'm looking at exactly the same factor, the price to book ratio, except I'm just looking at the last 10 years. So previously we've been looking at almost 7 decades of data. Here I'm looking at the last 10 years. And what you'll notice is the chart has completely flipped around. Now, the stocks with the highest or most expensive price to book ratios have actually outperformed over the last 10 years. And those with the lowest price to book ratios, the ones that won in the longer history, have actually underperformed by about 2.5 percentage points per annum in the last 10 years. So while this factor looks like it works over the long run, it's been perverse over the last 10 years. So one of the things we're looking for in a good factor is consistency through time. Obviously, a lost decade is not particularly useful if you're actually managing money in real time. So here's the performance of the price to book ratio by decade. And this is a good way to visualize the consistency of a particular factor. And here I'm looking at the differential in returns between the cheapest and most expensive quintile based on price to book. And you can see that, in the 1970s, for example, it did very well. But more recently, as we saw in the previous chart, it has not done well. And the last 10 years in particular have been pretty tough sledding. If you based your investment strategy on buying stocks that look cheap in a price to book sense, that would have destroyed about 5 percentage points of alpha per annum. So you would have been out of business well before the decade was up. So while this simplistic factor is a good example of what a factor is, it's not a particularly useful one given its lack of consistency. The other consistency we want in a good factor is it needs to work in as many subsets of the market as possible, right? So we want it to work in each sector. So for example, if I took energy stocks and ranked them by their price to book ratio, I would want the ones with lower price to book to outperform and the ones with higher price to book ratios to underperform. Here I'm looking at the performance of this factor in each sector, again, over the last 10 years. And unfortunately, it hasn't worked in most sectors either. So again, a good factor would be consistent not just through time, but also across sectors and other subsets of the market. And this is not the case with price to book. So what does work? What should we focus on? Well, one of the things that has been quite helpful over the long run and more recently is a slightly different flavor of valuation, and that is the free cash flow yield of a company. So the free cash flow yield of the company is the free cash flow of the firm divided by how much you're paying for the firm or the market cap of the firm, right? So this is just the inverse of like a price to free cash flow ratio. Here we're just doing it in yield terms. So in this case, the higher yield stocks, those are the cheaper stocks in a statistical sense. They're the ones where the market is quite skeptical that the free cash flows on offer in that company are sustainable. So here's the same chart we saw for price to book, except now using this new candidate factor. And here we see a couple of things. Firstly, over the long run, this factor has also worked. Stocks with the highest free cash flow yields have outperformed, but they've outperformed by a lot more than what we saw with price to book. They've outperformed by about 5 percentage points per annum. And the stocks with the lowest or most expensive free cash flow yields, they have underperformed by 4 to 5 percentage points. So we're seeing much bigger numbers here over a comparable time period to what we saw with price to book. So that's promising. But again, remember, we need consistency in our factors. So let's look at that. Here's the performance of this factor by decade. And this one has, on average, worked every single decade since the 1950s. And you'll also notice that unlike price to book, it's done very well in the last 10 years and it's done very well in the last 5 years. So there's that consistency that we're looking for. So this seems like a better factor at first glance than what we have with price to book. Here's another factor that's been quite helpful. What I'm looking at here is looking at sorting stocks by their free cash flow margins. So the free cash flow margin is your free cash flow divided by your sales, right? It's kind of a measure of, in a sense, the value add or the moat that you have. If you can command a high margin, generally it means you've got a pretty good product that you're trying to sell. Maybe you have some high barriers to entry, you're able to charge a high markup. So here we're looking at what happens if I just bought companies with high free cash flow margins and avoided companies with low free cash flow margins. Well, interestingly, that strategy has also worked every decade since the 1950s, and it has been particularly potent in the last 5 and 10 years. In fact, the return spread between the highest and lowest free cash flow margin businesses has been around 12% over the last 10 years per annum. So that's a pretty substantial return spread. And you can also see that the potency of this factor has actually been growing over time. In Module 2, we'll talk about some of the reasons why that might be. But for now, we can see that this factor has offered some pretty good consistency as well. So those two together, the free cash flow yield is how much am I paying per dollar of free cash flow in that company? And the free cash flow margin is kind of a measure of efficiency. How good is this company at taking a dollar of sales and giving me back free cash flow? So those two factors look like more promising candidates in what we're trying to do here. What should you do with this free cash flow? Well, it turns out another good strategy or factor is to look for companies that are giving the money back to their shareholders. So what I'm looking at here is the performance of buybacks as a factor. So if I rank all my stocks by how big their buybacks are, and I go long the stocks that are doing the most buybacks and short the stocks that are doing the least buybacks, that's also been a pretty effective strategy. You can see it's also worked every decade that we have data for, and it's been pretty good in the last 5 and 10 years. So here's another factor that's relatively consistent over time. So the basic picture that's starting to emerge here is what kind of companies do I want to look for? I want to look for companies that are producing a lot of free cash flow, i.e. have big free cash flow margins. The market doesn't believe in those free cash flows, i.e. they're trading at high free cash flow yields, and they're giving a lot of that windfall, the big free cash flows, back to shareholders via share buybacks. So we're starting to build up a picture of maybe how we could triangulate some statistically good companies. And this is the whole goal of any kind of factor research, is to come up with a set of factors, or just think of them as screens, that help us narrow down the investable universe and find companies that have, hopefully, a statistical tailwind behind them. What we're ultimately trying to do is just fish in a better pond. Most of our clients here at Empirical, and I think most of you listening to this as well, are going to be bottom-up fundamental stock pickers, right? So you're going to really get down in the weeds on companies. You're going to try to understand their business models, how their management's doing, what their growth opportunities are, all those traditional things that analysts scrutinize. But we can help ourselves by fishing in a better pond, right? There's thousands and thousands of stocks out there around the world. How do we pick which ones to do that deep dive on? You can't possibly analyze every company in the world in excruciating detail. So you're going to need some kind of pre-screening criteria. And so when we talk about factors from a fundamentalist perspective, we don't just care about the average return of those factors, which is what I've been showing you so far. What we care about is also the win rate. What percent of stocks actually outperform? So what I'm looking at here is the stocks that screen in the best and worst quintile of these 3 factors that we've been talking about. And this is their win rate. What percent of those stocks outperformed over the next year and underperformed over the next year? And the gap between the gray and the black bar is kind of how much are we shifting our table odds in our favor? And you can see in these bars, that's anywhere from maybe 5 to 8 percentage points, which doesn't sound like a lot, but if you have a 5 to 8 point edge and you apply that consistently over time across lots of stocks and also across time, that's like flipping a bias coin lots of times, right? On one flip, it's close to 50-50. But if I do 1,000 flips, it's almost sure to add up in my favor if I have that kind of edge. And that's the idea with these quant tools that we're trying to use as fundamentalists, right? We're just trying to give ourselves a slightly biased coin, and then we want to apply that edge consistently over time. And so when we're looking at factors, we want to see differentials like what we see here. You know, we want a 5 to 10 point edge in the base odds that we're dealing with. And then if I'm a good stock picker and I apply my stock picking skill to that pond that has a 5 to 10 point edge over just all the stocks in the market, that is a really considerable advantage. And so that's all we're trying to do here is just shift the odds a little bit in your favor. And that's going to add up over time. Let's also think about what doesn't work, right? So I've kind of given you a very crude template of what we might want to look for. Big free cash flow production, where the market kind of doubts that free cash flow production is sustainable and the company's doing a good job of giving that windfall back to shareholders. One of the things that doesn't work, which is probably the single biggest mistake that we see fundamental investors make, is chasing growth too aggressively. So what I'm looking at here is another factor, and this is just year over year sales growth. So it's very simple. I'm ranking all of my companies based on their growth rate over the last 4 quarters. The companies on the left have the fastest growth rates, and the company on the right here have the slowest growth rates. Now, most of us as investors are naturally inclined to lean towards the faster growing companies, right? Those are the exciting ones. Those are the ones where maybe they have great prospects in the future. Here's the problem. As shown in the black bar here, if I just mechanically buy a basket of stocks with top quintile sales growth rates, those stocks have actually historically underperformed the market over the last 7 decades by about 2 to 2.5 percentage points per year. So buying the fastest growing companies has been statistically a losing strategy pretty consistently. Conversely, buying low growth companies, which sounds kind of counterintuitive, has actually been a good strategy. On average, those companies have outperformed by maybe 75 basis points per year. So one of the worst things you can do just statistically is overload a fundamental portfolio with a lot of high growth companies. The odds of those paying off are not nearly as high as what investors think. Let's dig into that in a little bit more detail. Here is the performance of high growth companies relative to low growth companies by decade. So again, remember, we're kind of interested in how consistent is this over time. And what you can see here is it's been pretty consistent, right? High sales growth has pretty consistently underperformed low sales growth for most decades. And that, again, has been the case in recent years as well. So chasing after high growth has pretty consistently not been rewarded. Why is that? It's worth digging into this in a bit more detail because it is, again, one of the most consistent mistakes that we see fundamental investors make. And I'll use a specific example just to illustrate what's going on here. What I'm looking at here in the white bars is the forecast growth rates for companies' free cash flows over the next 10 years in the middle of 2020. So let's rewind the clock a bit. Early mid-2020, that was a pretty crazy time, right? That was as the market was rebounding off of the pandemic. The market bottomed on March 24th of 2020 and then started to recover after obviously some government intervention, fiscal stimulus, etc. So the white bars are the explicit forecasts that analysts were making at that period. Out over the next 10 years. And this is the distribution of those forecasts, right? So we're looking at the expected growth rates for all the companies that were being forecast over that period. Now, by way of comparison, the gray bars are the growth rates that have actually been realized over the long run. So that's the distribution of actual realized growth rates for all the companies that have been in the stock market over the last 7 decades or so. So that's the actual realized outcome. So if you look at those white bars, what strikes you? The thing that stands out most is there's no forecast for negative growth rates. Everyone that's covering companies always thinks their company is the one that's going to grow up to be a superstar, and someone else's company is going to be the one that fails. It's kind of like how everybody thinks they're an above average driver, right? Exactly the same phenomenon. And so what's going on here is analysts and also investors underestimate the failure rate. The black bars are showing you what happened at the peak of the dot-com era at the end of 1999, just as another example here. And what I want to call your attention to is the left-hand bars here. In December of 1999, 35% of the companies that were listed back then did not survive the next 10 years, right? That's because we went through, obviously, the dot-com bust. The NASDAQ peaked in March of 2000, sorry, and collapse from there. The gray bars show you that over the long run, a full 20% of companies don't typically survive 10 years. But again, look at the white bars. Nobody ever forecasts that their company is going to be the one that fails. So what is happening in high growth companies is the failure rate is being underestimated. Everybody thinks their stock is going to be the next Amazon.com, whereas the reality is a lot of them will be the next Pets.com. And so that underestimation of the failure rate is why investors tend to pay too much for fast growing companies. And so one of the rules that quant can help us apply is don't get over enamored with fast growing companies. It doesn't mean we can't buy them, but the weight of evidence we need to buy such a company should be higher than what the market typically demands, because the market is not correctly estimating the odds of survival in most of these companies. The other mistake that I think is made a lot of the time has to do with the macro environment. And again, we're going to talk more about this in Module 2. But just to give you an example here, which is pretty topical over the last 4 years since the pandemic, is this chart here. The thin line in this chart is what I'm going to call the price of growth. What that is how many PE points are investors willing to pay to buy 1 extra point of top line growth? So you can think of it as like the ratio of price to growth, right? Or how much you're paying per unit of growth. And that line, the thin line, peaked in February of 2021. That was the height of the meme stock era. That was GameStop going to the moon, Reddit, all of that. Pretty crazy times. That was the highest price of growth we've ever seen in the US equity market. Now, what was going on? The thick black line is the real yield on the 10-year Treasury bond. And that was negative at that point. The opportunity cost of money was negative. So you probably should swing for the fences. Right? When you've got a negative real yield, it kind of makes sense to reach for anything that might give you a return, Bitcoin, meme stocks, just equities in general. And so if you look at the thick black line, it's very negatively correlated with the thin line. In other words, when the real yield goes down, the price of growth shot up. And that was particularly true in kind of 18, 19, and then the first 2 pandemic years. So we had a period from about 2018 through to 2021 where fast growth stocks were actually being rewarded. And a lot of stock pickers thought, they were the smartest guys or gals in the room because everything was going up, and they thought they were picking great stocks. But it really had nothing to do with that. It was just a bigger macro phenomenon created by what was going on with yields in the market. And so I think that's one thing we need to keep at the back of our mind when we're thinking about factors. There are periods where high growth stocks do actually outperform, but often those are much more a function of the macro environment than anything else. And it's very easy to start thinking that you're very smart in those periods because all of the stocks are going up. but it's not really the stock picking, it's just the broader macro environment. So kind of the moral of the story is don't get carried away with growth rates. Make sure you anchor yourself on the odds that actually pays off, which are lower than what the market generally thinks. So again, quant can be a useful set of guardrails here when we're thinking about these relationships. Here's another way of putting some perspective around this, and I will spend a bit of time on this because, again, I think the easiest thing to do as a fundamental analyst is get a little bit over enamored with exciting growth stories. What I'm looking at here is the growth rate of companies cut by quintile. So what I mean by that is, again, we're going to take all our companies and we're going to rank them by just their top line growth, their sales growth. So if you do that, the companies in the left-hand bar here in the gray bar, they would typically have on average a revenue growth rate of maybe 30%. Right, so that's saying like the top fifth of companies when ranked by revenue growth typically have a revenue growth rate maybe in the order of like 30%, which is phenomenal, right? That's a super fast growing company. It's probably a really exciting story. Everything's going well. In the right-hand gray bar, the companies with the lowest top line growth rates in the lowest quintile are typically going to be like, -5 to 10% growth rates. So that's the initial ranking of these companies. Now, what we're looking at in the black and white bars is what was their revenue growth like 1 year later and 2 years later for those same companies. So not changing the sort, just tracking them over the next couple of years. What you'll see in the left-hand black bar is by the end of the first year, the growth rate in those fast-growing companies has already halved. So if you had a 30% revenue growth rate on average when we first formed the portfolio, 1 year later, your revenue growth rate is 15% on average. And then you kind of lose almost another half in the third year. So the revenue growth rate actually tends to mean revert on average pretty quickly. And by the 2 years later, you've maybe got a quarter of the growth rate that you had when you started. Now you'll notice in the left-hand white bar, it's still higher than most of the other companies, meaning a fast-growing company, its revenue growth starts to fade, but it's still actually a pretty fast-growing company compared to all the other companies out there. So it's not that the revenue growth doesn't come through at all, it comes through, but what happens is it doesn't come through as much as the market typically prices. And we can see that in this second chart here. What I'm looking at here is the PE ratios, the valuation of those same groups of companies. So the left-hand gray bar is companies in the top quintile of sales growth. They typically have an average PE of about 1.4 times the market's PE. So they trade at kind of a 40% PE premium to the market, right? So they're pretty expensive. But what happens after that is the valuations tend to come down because the growth rate doesn't come through as strongly as what the market was discounting. And so there's a disappointment effect, particularly in those fast-growing companies. It's not that they don't keep growing fast. It's just that the growth rate slows quicker than what investors think. So this is where just knowing the table odds can be really helpful, right? If I've got a bunch of fast-growing companies that I'm analyzing, I want to know, what's the base rate historically? What percent of companies in this sector or this part of the market have actually been able to sustain those super fast growth rates for 1, 2, 3 years? That's where a data-driven systematic toolbox can be really, really helpful. So I really want to emphasize what we're trying to do here is put some table odds around what typically happens in a stock with certain characteristics. Let me give you one other example just to make this a bit more concrete. One of the greatest bubbles in hindsight of all time was the dot-com era, also called the new economy era. That was when the NASDAQ went to the moon before that was a thing. But it peaked in March of 2000, right? And then it was followed by a pretty epic crash in all the tech stocks. So what I'm looking at here in the left-hand gray bar is, firstly, how fast were the tech leaders of that time, which would be like Cisco, Nortel, Lucent, some of those dot-com darlings. How fast were they growing in the 2 years before the peak? And the answer is they were growing at about 17% per annum, which is pretty fast, but not super fast. The black bar is what analysts were forecasting for their growth rate over the next 2 years. So in March of 2000, analysts were forecasting that on average, these tech leaders' sales would grow at another 50% per year for each of the next 2 years. So they were calling for a massive acceleration in sales growth in those tech darlings. The white bar shows us what actually happened over the next 2 years. And actually, compared to what went on in the prior 2 years, the growth rate wasn't terrible. In fact, it was a little bit faster. They grew on average about 22% per annum, right? So they had been growing at 17% a year for the 2 years before the peak in March of 2000. And they actually grew at about 22% for the 2 years after the peak. So if you just look at the fundamentals, like that's pretty good, right? They actually did accelerate their growth rate a bit. But the issue is the expectations just got way too high. Analysts were expecting this massive hockey stick in terms of sales growth, and it never eventuated. So even a, on paper, good result was not nearly good enough given the valuations these stocks were trading on. So the point here is the reason that very fast growth doesn't pay off is not because the companies always fizzle out. It's because the market price is even faster growth. And so we have to be vigilant to that because just as humans, we're all hardwired to want to run with the cool crowd, right? It's fun to buy exciting stocks that are growing fast, that are a part of some big, super story like AI, for example. But that ends up getting overpriced. And what gets underpriced is boring stuff that's maybe not growing as fast, that's reached maturity, that's generating a lot of free cash flow, but doesn't have a lot of growth prospects. And so quant in particular is really helpful, again, at putting some guardrails around, not getting too carried away with the exciting stuff, and not getting too gloomy around sometimes the more boring stuff. The other big mistake that we see in fundamental investing is related, and it has to do with capital spending. So I mentioned we want companies with big free cash flows generally. What do you spend those cash flows on? Well, one thing you can do is give it back to shareholders, which we've already established is generally a good thing, doing buybacks. The other thing you could do is invest it. You could spend a lot on capital spending, right? And try to grow. Use those free cash flows to grow. Now, that's not automatically a bad thing, but here's what's interesting. If I look at this statistically, stocks in the highest quintile of year-over-year capex growth have pretty consistently underperformed by about 4 percentage points per annum. So it looks kind of like sales growth. Ironically, you want to buy the companies with slower capital spending growth, which again sounds a bit counterintuitive, right? Those are the companies that have often gone X growth. They're not that exciting. They're just giving money back in dividends and buybacks instead of, trying to spend the money to grow. But that's what the empirical evidence says. It's pretty clear cut. You don't want companies to get carried away and drink their own Kool-Aid and add too much capacity and spend a ton of money on, building out new factories or opening new stores. Because again, humans tend to overestimate the payoff to those things. And often you're better off just giving the money back to the shareholders instead, rather than getting kind of delusions of grandeur and trying to spend your way to success. This is obviously very relevant right now when we think about what's going on in the Magnificent Seven type, AI stocks, right? Microsoft, Google, they're starting to spend a lot of money on the AI arms race. So once we've found some factors that work and hopefully avoided some of the factors that don't work, what we're ultimately trying to do is put them together to find the sweet spot. Because generally, if we have two factors that work, we kind of want the intersection of the two, right? So we've been talking about high free cash flow margin businesses. Generally, as I mentioned, those have been good. They've outperformed by almost 5 percentage points per year. The middle bar here is free cash flow yields. Buying free cash flows when they're cheap has also been a good strategy. But the two together has been much better still. If I buy the subset of stocks that has top quintile free cash flow margins and top quintile free cash flow yields, that's been worth about 9 percentage points of outperformance per annum. That's meaningful alpha. And so the idea here is to, slowly shrink the investable universe by adding together these factors until we get to a manageable list of stocks that have a pretty good statistical edge to them. Now, that doesn't mean we don't do any fundamental analysis, right? We could just buy the whole basket, but most of our clients would use that, again, as a statistically advantaged pawn to then go and do their deeper analysis on that. And hopefully you're starting with that edge in your favor. Now, we're going to narrow down the number of stocks as we do that, right? So if I look for the number of stocks that say have top quintile free cash flow margins, if I'm using our large cap universe here at Empirical, then I might come up with like 120 stocks that have top quintile free cash flow margins. But then I can narrow it down by also requiring them to have top quintile free cash flow yields. And then I could narrow it down further by saying I also want top quintile buybacks, right? So sequentially, we're kind of coming to that type of stock that I mentioned we're interested in, big margins, where I can buy those margins at a cheap price or a high yield, and the company's mostly just giving me the money back as buybacks. That's going to narrow me down to a real short list of stocks, maybe like what you see here, just a handful of stocks that meet all of those three criteria at once. Obviously, we don't have to be that stringent, right? Depending on how many stocks we want in our starting universe, we could loosen those constraints a bit. Maybe I look for the top 2 quintiles of free cash flow margin, but you get the idea. We're basically layering these things together to triangulate a subset of stocks that hopefully ends up on average outperforming over time and also has a high percentage win rate. And that's what we're trying to get to here with all of the quant tools that we're talking about. So that's really a very simple introduction to factors. Obviously, in real life, we can kind of expand that. And we're just going to take the same concept and essentially add more factors and get a little bit more nuanced about how we put the factors together. So just to give you a very brief flavor of that, here at Empirical, we've been running a stock selection model that we call our core model for more than 20 years now. And again, it's been in real-time use with our clients over that time. What that model is comprised of is lots of factors, just like what we've talked about today. And we break those up into broad groupings that we call super factors. And those super factors are shown in the slices of the pie here. Valuation is going to be all the factors related to how expensive is the stock. So that would be like PE, price to book. As we saw earlier, that factor is not a great one, so we put more weight on things like free cash flow yield, which is much better, as we've talked about. But we want a fairly nuanced, broad-based definition of valuation. Capital deployment, that's tied to things like capital spending and buybacks that we've talked about today. We want companies that are giving money back to shareholders and not getting too aggressive in terms of ramping up their CapEx. Earnings quality, we'll touch on that in modules ahead. That's going to be about the persistence of the firm's earnings, the consistency of the firm's earnings. Free cash flow margins that we talked about are one of the factors in there. And then market reaction is, what does the rest of the market think about this company? That's going to be things like price momentum, earnings momentum, things like that. So the idea is, by scrutinizing a company across all of these dimensions, hopefully the whole is more than the sum of the parts, right? We're putting all these different factors together to come up with some kind of sweet spot that has the right stuff that has historically outperformed. Let me just zoom into one of those super factors in a bit more detail. Here I'm zooming into the valuation component. So that was the gray slice on the slide that we previously saw. These are all the individual value factors that we look at here at Empirical. And you can see there's lots of them. And we'll talk later on in Module 4 about the way that we weight all of these different factors. But for now, you can see that this is just kind of a bigger version of what we've talked about today, right? We take a lot of these building blocks. We're looking for factors that are consistent through time, consistent across sectors, consistent in different economic regimes, consistent in different style regimes. And then we're putting them all together. And that's going to help us pinpoint a subset of stocks that has not all of these characteristics at once, but has enough of them that we think we have some kind of statistical edge. So that is really the goal in factor analysis. It's just to come up with a set of screens or rankings that can narrow us down to a statistically advantaged subset of the universe that we're dealing with. And if you apply that consistently over time, that is going to add up in your favor. But it does require discipline, right? It requires not overruling the screens every time, you like a stock and it's against you on it. It means paying attention to them, using it consistently as part of your investment process. But if you have that discipline and use these tools day in, day out, it's going to go a long way to giving you enough of an edge that hopefully you can have over time consistent success in picking stocks. In the second module, I want to talk about why things work. So in the first module, we discussed individual factors and we talked about some that we like, and that includes things like free cash flow yield, free cash flow margins, big buybacks, and some things that we don't like, fast top line growth, really rapid CapEx growth. But why? What is the economic or behavioral reason that we think those factors are going to keep working? Because as I mentioned in the introduction, the problem with any factor is it might just be a statistical artifact, right? If you run enough correlations, you're always going to find something that's correlated with future stock returns, but there may be no causality there. And when there isn't, it's probably going to break down in real-time performance out of sample. And this problem has become particularly acute in the modern era because we have basically unlimited computing power. We have almost unlimited data. You are always going to find something that looks like it predicts future stock returns, but the chances are you've overfit it to history. It's just some random artifact, random data variation, and because it lacks any kind of causality or economic rationale, it collapses out of sample. So I want to spend a little bit of time thinking about why things work. And this is just scratching the surface. For every factor that you'll come across, you want to go through this same exercise of thinking about what is the root thing that I'm betting on here. But today I want to give you a little bit of a flavor for some of the factors that we've talked about. Why do we think they work? So let's return to one of the factors that we talked about earlier. Here I'm looking at, again, the performance of free cash flow yield by decade. So again, this is going long companies with high free cash flow yields and avoiding or going short companies with low free cash flow yields. So a high free cash flow yield means you kind of look statistically cheap on free cash flows, and a low yield means you look expensive. And as I talked about earlier, that has been a pretty consistent strategy over 7 decades and counting now. So that's a good factor. The second one that we talked about earlier was buying high free cash flow margin businesses. And again, what you can see here, and as we saw earlier, this has been a consistent strategy that's actually been getting better over time. Buying high margin businesses has been worth 12 percentage points of outperformance relative to low margin businesses over the last 10 years, for example. So these two factors, which are tied to free cash flow production, have been pretty useful, and we've used them pretty successfully in real time for 2 decades now. Why is it working? Well, one of the reasons it's working is free cash flows have been getting bigger. And the reason they've been getting bigger is the capital intensity of the listed US economy has been going down. So if I look at the market-wide capital spending to gross cash flow ratio, you can see that for many decades now, it's actually been coming down. And even though it's moved back up a little bit with the CapEx boom that's been triggered by the AI arms race that we're in now, it is still close to the lowest level that you've ever seen in 70 years of history. Right? So for every dollar of gross cash flow, US companies have to spend less of that on CapEx than they have at almost any point in history. In other words, the whole listed economy has become very CapEx light. Now, what's been going on here is a combination of things. One of the big things that's gone on over this period is globalization. US companies have done a very good job of getting someone else to spend the CapEx for them. So if you're Apple, for example, you're not actually building the iPhone, Foxconn and others are building it for you. So they take all the low margin parts of the business off your hands. They're the ones that build all the factories, spend all that CapEx. You keep the high margins for yourself and your shareholders. So the reducing capital intensity of the US economy has freed up free cash flow for shareholders. And that's been an ongoing trend for decades now. As I mentioned, firms that tend to grow their CapEx aggressively have pretty consistently underperformed over time. So here I'm looking at decade by decade, the performance of stocks in the highest quintile of free cash flow margins and the lowest quintile. And in the black bars, having fast capex growth has underperformed on average in every single decade over the last 70 years. So this is one of the most enduring anomalies that we've seen in equities. But why is that happening? Well, one reason it's happening is, as I mentioned, we've been moving to a capex light world. So if you can produce returns without having to spend a lot of capex, that's good. There's a lot of companies that have naturally capex light business models that spin off gobs of free cash flow. Why would I want the companies that have to aggressively spend money to get to the same place? So companies that have really reached for big growth via capex have not consistently been rewarded. In fact, they've consistently underperformed, as you can see here. So particularly as we've moved away from a kind of industrial, asset-heavy economy to a services and high tech and intellectual capital economy, the penalty for big capex growth has endured because you just don't really want those companies in a capex light world. Now, it doesn't really matter how we choose to measure capital spending. We've done a lot of work here in Empirical using generative AI to tease out what companies are saying about their future CapEx plans. So for example, we could ask ChatGPT to listen to the conference calls that companies do after earnings and just pull out any references the company makes to capital spending plans. And it turns out in the left-hand black bar, companies that talk about increasing their capex on the conference call, as judged by ChatGPT, have tended to underperform, and the companies that talk about cutting their capex have tended to outperform. The same is true, as we've talked about already, with trailing capex growth, and the same is also true with analyst forecasts for capex growth. So pretty consistently, either saying you're going to increase capex, or analysts forecasting that you're going to increase capex, or just having increased capex historically, all of those things are bad on average for future returns. So this chart kind of summarizes what I'm getting at here. The thick black line in this chart is the cutoff to be in the top quintile of free cash flow margins. So what does that mean? It means if I take all my stocks in the market and sort them by their free cash flow margins, the black line is the cutoff to make the top 20%. So right now, you need a 20% free cash flow margin to be in the top 20% of the market. Just stop and think about that for a second. That is extraordinary. 20% of US companies have a free cash flow margin above 20%. If you go back 3 decades, the start of the 1990s, you only needed like a 7% free cash flow margin to qualify for the top quintile. So the bar has steadily been raised over the last 3 decades. The US stock market has become a more and more efficient engine at taking $1 of sales and giving me like a quarter back as free cash flow. That prodigious free cash flow production has been one of the reasons the US equity market has been hard to beat. If you can't think of anything else to do, you should probably just be long the black line in this chart. Compounding a 20+% free cash flow margin every quarter is a very powerful strategy because it adds up very quickly, those huge free cash flows. Now, the reason betting on things like big free cash flow margins has worked is because the market's always been fairly skeptical about how high these margins could go. And the reason I say that is the thin line in this chart. The thin line in this chart is looking at how much am I paying to buy these big margin businesses? So this is the relative free cash flow yield of these high free cash flow margin businesses. So that's a bit of a mouthful, but let's just unpack that. The thin line is basically the yield on this basket of high margin businesses. So as a yield, the higher the line is, the cheaper the stocks are relative to the market, and the lower the line is, the more expensive they are. So let's go back to, say, 2012, for example. Back then, in the thin line, these high margin businesses were trading at 3 percentage point yield above the market's yield. In other words, they were a lot cheaper than the market. And you could, at that time, in the thick black line, those companies had maybe, I don't know, 17% free cash flow margin. So back in 2012, I could buy a bunch of 17+% free cash flow margin businesses for like 300 basis points yield above the market. In other words, the market was very skeptical that those free cash flow margins were sustainable. In fact, they were betting that they were going to mean revert. And that's why they weren't willing to pay a high price for those existing free cash flows. They didn't think they could keep going. So every time you show somebody this chart for really the last 2 decades, the pushback's always, well, now you're definitely at peak margins. But the market's been consistently wrong on that, and they've undervalued these big free cash flow margins, always overpricing a mean reversion in these margins. So when we can buy these big free cash flow margin businesses on the cheap, that's been a winning strategy for decades and counting now. You can also see a recent example in this chart. See the spike in the thin line on the right here? In the middle of 2022, the yield on these big margin companies had spiked up to about 250 basis points above the market's free cash flow yield, one of the higher readings that you've seen over the last couple of decades. Now, if you think back to what was happening back then, everybody was convinced a recession was imminent. The Fed had started raising rates aggressively. Everybody thought that the free cash flow margins were going to collapse. Well, what's happened? They pulled back a bit, but they're still close to the highest they've ever been in history. So the market has a tendency, again, to overestimate how quickly the margins are going to attrite. And by taking the other side of that skepticism, we can exploit that mispricing, right? We can exploit that excessive pessimism that the market seems to express around free cash flow margin. So this is a really important concept, certainly in our work here at Empirical. Anytime we can buy a big margin business at a decent price, we are interested. That's been a winning strategy for many decades now, and it's kind of the bedrock of why our stock selection models here have been very successful in live performance. The market has never fully appreciated just how durable these big free cash flow margins are. Now, the problem with all of this is, are we at peak margins now? Right? Maybe the market's finally right and these free cash flow margins are not sustainable, in which case everything we've talked about so far starts to break down. Because again, if I buy a high margin business every time the price is cheap, I'm betting that the market's too pessimistic and ultimately the margins are going to hold up. What if the market's right and the margins collapse? Then I'm wrong and I'm going to underperform massively. So when I talk about factors, we have to do a lot of deep work to understand whether the things that underpin them are going to keep working. And in this case, what I have to understand is, are those free cash flow margins that have been on a steady march up for 3 decades now sustainable? And so a lot of our work here at Empirical is trying to dig into things like that and understand these multi-decade trends. And I'll just use this as kind of an example of, I think, the level of detail one needs to go in when thinking about factors. And ultimately, if you want to bet on a particular factor, I think you need to do this due diligence to make sure that the tailwind it had is still intact. So let's look at these free cash flow margins. Why have they gone up steadily for multiple decades now? Well, we can decompose where the margin expansion has come from. And this chart here is looking at, over about the last 20 years, what has driven the margin expansion that we've seen in these businesses. And you can break it down into roughly 3 things. First, interest rates went down for most of that period. That reduces your interest expense and obviously increases your margin mechanically. So that's been a tailwind for 20 years, falling interest rates. The second thing that's been helpful is tax rates have also been coming down, right? It's not so much that tax rates have come down in any one country, although, of course, in the US, we did have a step change with the Tax Cuts and Jobs Act at the start of the Trump administration. That was helpful. But more of what's going on here is kind of a race to the bottom globally. If you're a big multinational, you can park your intellectual capital in somewhere like Ireland or Switzerland or Singapore, a low tax country, and generally pay a lower rate than whatever the statutory rate is. So that trend has been helpful as well. So those are 2 big drivers of why the margins went up over this period we're talking about. The third force, I'm going to say, loosely call it globalization, which is that force that I mentioned earlier, companies getting out of the CapEx intensive parts of their business, getting someone else to do that for them, leveraging global supply chains to reduce the cost of inputs. That has also been a tailwind to margins over this period. So if you look at those 3 forces, how many of those are still intact? Certainly interest rates are going up. tax rates with the deficits that countries are facing now, including our own, can they keep going lower? It seems like perhaps the pushback will be in the other direction. And then globalization has been under threat, not just from the pandemic supply chain kerfuffle, but just geopolitics in general, a pivot away from China as a manufacturing center, partly for, again, geopolitical reasons. So maybe the market's right now. If all of these forces that were tailwinds for 2 decades go into reverse, maybe that black line we saw in the previous chart does start to roll over. And then we don't want to be caught in those big margin businesses because those big margins are going to crumble. So that's what we have to grapple with here. What we would do is dig into each of those forces in detail and try to determine how quickly they're going to roll over. And sometimes it's not what it seems. So let's take the interest rate component as an example, right? It's very easy to stand here and say, okay, rates went down for 20 years from a high starting point. We're not going to replicate that. But that overlooks some of the nuance here. What I'm looking at in this chart is the structure of borrowing for large and small cap US companies. And if you look at large caps, which would be like S&P 500 companies, shown in the gray bars here, they actually have very little variable rate debt. Most of their debt is fixed rate debt. And the maturity on that fixed rate debt, in many cases, in fact, in 40% of the borrowing, is not until the 2030s. So large cap US companies did a very good job of locking in pretty much the lowest rates in history for the better part of a decade. Now, that's not the case with small caps shown in the black bars here. Small caps, almost 30% of their borrowing is variable rate debt, which means they're immediately paying today's higher interest rates. So that's a huge drag on small caps. But it's actually not a substantial drag on large caps unless rates happen to be really high 10 years from now, which is, not a problem that's on the immediate horizon. So what it means is US large cap companies kind of look like US mortgage holders. They did a good job of locking in low rates and fixed rates at that. So the thin line here is the rate you're paying on new origination. So if you have to go to the market and borrow now, obviously it's gone up. But the dashed line is what you're paying on your existing borrowing. And that's only started to move up glacially because most of that debt is fixed rate debt and you only pay higher interest rates when it finally rolls over. And most of it's not going to roll over for a decade. So large cap companies are actually pretty insulated from that. And you can see it in this chart. If you model out, say, what would a 4.5% treasury bond yield do to the margins of large and small cap companies, what you find is it has very little impact on large cap margins, but it has a very big impact on small cap margins for the reasons we talked about. So if you're assuming that margins in the large cap companies like the S&P 500 are going to crack purely because rates are up, that's actually not entirely correct. Eventually, maybe, but it's a long time away, well beyond kind of the horizon the market typically discounts. So even in something as simple as interest rates, there's nuance underneath the surface. And so we're not convinced that rising rates are going to be that big of an impact on large cap margins. Now, in small caps, different story. And that's one of the reasons we're quite cautious towards small caps in our work. But large caps largely insulated from it. So we shouldn't be too quick to assume that margins are going to mean revert for that reason. What about the globalization issue? Well, that's another one where digging into the details matters. I think one of the things that really stands out when you look at globalization is the gap is still very, very big between the wages in the US and the wages elsewhere, right? So there's been a lot of talk about reshoring, bringing stuff back on shore after the pandemic and now with, again, geopolitics. But the wages of manufacturing workers in the emerging markets that we tend to buy stuff from are still only 10% of what you pay an American worker. That's in the gray here. So to unwind globalization, somebody's going to have to cover that spread. And that's an enormous spread to cover. In select industries, the government's willing to cover it, right? So we have the CHIPS Act, for example, for semiconductors. That's basically effectively subsidizing some of that spread. But in a lot of other industries that aren't, as geopolitically important, the consumer is not going to be willing to cover that spread. The government's not going to cover it. That makes it very hard to bring a lot of manufacturing back on shore. The gap is still enormous. The other thing that I think is overlooked in this a lot of the time is what's shown here. If you look at US multinationals, Why are companies multinational in the first place? Well, mostly it's because that's where their customers are, right? So I think there's this popular perception that, you make something in China and sell it in Walmart. And that's true. But actually, if you look at it, only about 10% of what multinationals make offshore in their affiliates comes back to the US. That's shown in the gray bars here. The rest of it is either sold in the host country or sold in usually countries quite nearby, right? So it's not like you are necessarily making something in China and bringing it back to the US. That's only 10% of what's going on. A lot of it is you're making something in China and selling it to Japan. You're making something in China and selling it to Thailand, Singapore. And so that makes deglobalization harder, right? Because if you really want to do it, you're saying you're going to make stuff here in the US and then sell it to all these other countries. You could plausibly maybe say, you're going to make something in Ohio and sell it in Indiana, right? But are you really going to make something in Ohio and sell it to India? That's 90% of what globalization is. So we are not that convinced that you're going to see this massive deglobalization. What's going to happen, and I think we see evidence of that now, is you're just going to shuffle things around, right? You're going to make iPhones in India instead of China. You're going to use Vietnam and Mexico instead of China. China's going to take advantage of that by, investing in manufacturing plants in those regions to get around things like tariffs. But it doesn't look to us like it's going to be a massive unwind in this globalization paradigm. It's more just a reshuffling. So to summarize, we're not convinced that interest rates going up has an immediate effect on margins. We're not convinced that the so-called deglobalization is going to have an immediate effect. That leaves tax rates. And this is, I think, perhaps the biggest worry because that can change very quickly. Obviously, raising taxes is hard for governments, but the reality is deficits are quite big now, and at some point, something's going to have to give. So I think there is a risk to margins from higher tax rates. That would probably be the most immediate concern. So we shouldn't be naive here, but when we decompose it all, we're not convinced that the reversal in these forces that have driven margins up for 20 years is going to immediately go into reverse. The other big thing that's sitting out here is the rise of technology, AI, robotics, automation. Most of the evidence on these technologies points in the direction of margin enhancing rather than margin destroying. Because a lot of what it does, things like robotics and AI, is entrench the advantage of scale. If you look at something like where industrial robots are used, as you would almost certainly expect, most industrial robots are used in big manufacturing plants, those with 1,000 or more employees, right? Because the advantage of automation is scale, right? There's a big upfront cost, a capital cost. But if you can make lots of widgets with that equipment, very quickly it's going to pay off. If you've a very small facility, you're probably not going to have much use for robots because that capital cost ain't going to be worth it. So robotics has been something that has enhanced the moat that scale produces. Now, AI is another technology in that direction. Who other than the biggest companies have the data already saved down, the computing power, and can afford the talent to actually take advantage of AI? The academic evidence leads in that direction as well. If you look at the increase in sales that comes from implementing AI, and there's been, again, some academic research on this reference down at the bottom here, what they find is the same thing. Most of the improvement accrues to the biggest firms. So we've seen that, I think, in the mega cap tech leadership recently as well. Far from being a disruptive force, it seems to have entrenched the advantage of the big guys because it just deepens the moat even further for small competitors to take over. So at the same time as we have forces that have driven margins for 20 years that might be waning, we have these other forces that are coming in that might actually end up helping to sustain the margins in the market's leadership. So these are just some of the things one has to think about when thinking about what type of factors you want to deploy. And I think this is something that sometimes in quant gets a little bit overlooked. There's a tendency to be a little bit black boxy, to just bet on things that have worked in the past without thinking clearly enough about, are those same relationships going to apply in the future? Why did this thing work in the past? Just on the point about AI, here's the free cash flow margins for AI companies shown in the solid line here, and the dashed line is the margin for the market overall. And so the AI companies have higher margins than the overall market does, right? So if that is a really big enduring theme and those companies get bigger, that is going to be something that actually pushes the margins up, not down. So again, I think we have to be careful about over asserting that margins are about to mean revert. If they don't, then I think a lot of the factors that we've talked about so far still have some validity, and that's our base case right now. Now, we've been focusing a lot on free cash flow. So just as an aside, I do want to mention that what I'm talking about is not exclusive to free cash flow. There's other measures of earning quality, like return on invested capital, for example, that have also produced alpha over time. But generally, we've found that free cash flow based metrics, like the ones we've talked about, free cash flow yield, free cash flow margin, have been better over the long run than some of these more traditional measures like return on invested capital. But again, you don't want to put all your eggs in one basket, right? When we looked at our own model in the previous module, you would have seen we have lots of different factors trying to measure a certain dimension. The same is true here. I don't want to exclusively rely on, say, free cash flow margins. We look at lots of other things as well: return on invested capital, accruals, which is kind of an academic definition of accounting quality. The number of patents a firm has procured is often indicative of, is it going to be able to produce new innovation and ultimately earnings down the road? So don't put all your eggs in one basket. But if you have some confidence, you understand the underlying drivers of a factor, we would emphasize that factor just as we do with free cash flow based factors. In module 3, which is going to be a shorter module, I want to focus on events that have historically been helpful for stock returns. So the type of events we're talking about are things like getting a new CEO, an activist targeting your stock, maybe adding a dividend, things like that. So we've always found that there are certain events that can befall companies which are net positive for future returns. And it's worth just knowing what those are, because then if you see one, you just kind of know at the back of your mind, okay, historically, so-and-so happening to a stock has been worth, X percentage points of alpha. Doesn't mean it's always going to play out that way, but again, it gives you some sense for the table odds that you're dealing with. So let's talk about what some of those events are. One of the events that is pretty prevalent in the market is, of course, M&A. And M&A is an interesting event. If we look at M&A from the perspective of the acquirer, that is the company that's buying the other company, on average, over the long run, M&A has been value destructive. That's shown in the left-hand bar here. So the average M&A acquirer has underperformed by about 1.5 percentage points in the year after the acquisition. So that's not massive, but it is a drag, right? And then all the other companies that don't do acquisitions have kind of outperformed a little bit. That's over the long run. You'll notice in the last 5 years on the right, acquirers have actually done okay. So sometimes it can work, particularly if you have some kind of tailwind like cheap capital or some other macro force going on. But generally over the long run, you should assume that M&A is not automatically a good thing. Now, some M&A is worse than others, and this is where having a little scorecard can be helpful. So let's say an M&A event has just happened to your company. We don't have to start from scratch. What we can do is go back and think about, what are the characteristics of an M&A deal that have historically been good and bad for the success of that deal? And here's the factors that we've found are helpful in determining whether an M&A deal is going to be successful or not. Firstly, valuation in the black bar. This is probably not a huge surprise, but if you're doing the M&A at a high valuation, that is less likely to work out, right? You're much better off if you can buy something cheap. And also when you're trading cheap as well is quite helpful. If your own stock is expensive, chances are you're buying someone else that's probably pretty expensive as well, often at the peak of the economic cycle when nobody's too worried about valuation. That on average does not work out. How you're paying for the deal actually matters. It turns out that cash is best and all stock transactions are bad. Now, that's not because all stock transactions are bad in and of themselves. It's not because that is just a causal thing. The reason it's bad is people tend to do all stock transactions, again, at the peak of the cycle, because their own script is pretty expensive, right? Chances are they're buying someone else in the industry also at a pretty expensive price. So it's more just an offshoot of the fact that those deals tend to happen at inopportune times when everything is frothy. So if you see a deal where, the valuations are explicitly expensive, it's doing it in all stock, those are two kind of red flags. Other deal characteristics you want to watch out for are things like if you're doing a competing bid, if it's an unsolicited bid. Generally, that just means you have to pay more to get the thing done, right? So it's tied again into the valuation aspect here. If it's a friendly bid and both parties are on board, that's generally better because you probably don't have to pay as much. If you're competing with somebody else, you're going to have to outbid them, which kind of puts you behind the game right off the start. The other thing that is relevant here on the left is how fast has the acquirer been growing? Has your capex been big relative to your depreciation? Has your book value been expanding rapidly? Has your long-term debt been expanding? If all of those things or some of them are true, that is actually worse for the success of the deal because it's a sign of what we talked about earlier. You don't want companies that are overreaching, that have drunk their own Kool-Aid, that have gotten into kind of, empire building mode where they're just trying to expand as fast as possible. Rather, remember what you're looking for generally is companies giving money back to shareholders. If you're doing all of this growth, often you're getting carried away. So the picture that we're building up here is bad M&A happens in a frothy market, typically all stock. Valuations are high, both for the acquirer and their target. Maybe you're competing against other bidders, and the acquirer has been growing very fast going into the deal. All of those are warning signs. Again, it doesn't mean the deal is going to fail, but as a fundamental stock picker, you'll all the time be involved in deals where your companies are either the acquirer or the acquiree. If they're the acquirer, you want some kind of scorecard or checklist that you can pull out of your back pocket and just score that deal. And that's what we do in our models, and that's been very helpful over decades now. So M&A deals, you can get a little bit of an edge just by knowing what has historically been rewarded. Here's the performance of this M&A scorecard that I showed you on the previous slide. If you look at the companies that have done deals that score worse on that scorecard, that's the right-hand bars, those companies have underperformed by about 10 percentage points per year, whereas those that are doing better deals have tended to outperform. So we're not saying all deals are going to fail, right? If you do a deal and it's got favorable characteristics, that's been worth like 2 percentage points of outperformance for the acquirer. You also notice it's kind of monotonic here, meaning it kind of moves like smoothly from high to low, right? Meaning that this is actually quite a good factor. Going back to what we talked about in module 1, I can make a factor by sorting all my companies by the quality of their M&A if they've done a deal recently, and buy the good ones and avoid the bad ones. So scrutinizing M&A transactions is well worth doing. Another good one to watch for is getting a new CEO. And this is topical recently, right? The Starbucks had a pretty good pop after it got a new CEO. But you see this more generally. So typically, companies that get a new CEO over the long run have outperformed by about a point per year. That's not huge, but it's also not nothing, right, on average. And over the last 5 years, the boost from getting a new CEO has been a little bit higher than that, maybe 1.4 percentage points per annum. To be clear, this is not because the new CEO is automatically good or bad. It's because of the way equity markets work. Usually, when you get a new CEO, what you had been doing hasn't been working. Often the stock price is under pressure. So the market's like, trying anything is better than just doing nothing. Just plodding along with what hasn't worked is not really a recipe for success. So the market gives you some credit for mixing things up and actually getting somebody new in the seat. So the new CEO, it might not be that they have any better ideas than the old CEO, but the market does give you a little bit of credit for getting someone new. So again, we have a flag in our models that just gives companies a little bit of a boost up the rankings if they've gotten a new CEO recently. There's some empirical evidence behind that. Another event that has become quite relevant recently is activist investors. There's a lot of activist investors running around, in Disney and Starbucks again recently, things like that. Actually, if you look at it over the long run in the left-hand gray bar, companies that have been targeted by activists actually haven't done that well. So historically, at least from the perspective of the business they're investing in, those stocks have kind of underperformed over the next year by about 2 percentage points per year. More recently, though, activists have been pretty good. It's been worth about 6 points of alpha per year. So this is a tricky one, right? Because it doesn't meet all of the criteria I talked about in module one, right? You want some consistency over time. This one has flip-flopped a bit. So this is one where I think it's worth being aware of, that in recent years, having an activist target your stock has been good, but the longer term evidence is not as conclusive here. So that's one I'd be a little bit careful with, just because it lacks some consistency over time. We've talked about returning capital to shareholders, so I want to come back to that. A good event for companies is initiating a buyback, expanding an existing buyback. Historically, companies have been returning stock to shareholders or reducing their share count have outperformed by 3 to 4 percentage points per year. And those that are diluting you by raising capital, raising new equity, increasing their share count, that's the gray bars, they've underperformed by like 4 to 5 percentage points per year. So that's a pretty meaningful spread. So you want to look for companies that are initiating opportunities to give money back to shareholders. That can be buybacks, which is more prevalent these days, but it can also be dividends. If you increase your dividend, that has also been historically good. And that's true in the most recent 5 years as well. Notice the magnitude of the returns are not as big here. Here in the US in particular, buybacks are a more tax-friendly way of giving shareholder capital back. And I think investors generally prefer that a little bit more. Also, it's kind of discretionary. Like once you raise your dividend, you're sort of locked in. Buybacks, you can fiddle with on an ongoing basis. But anyway, both giving capital back through buybacks and giving capital back through dividend increases, both of those are good things. If you see them in a company, on average, it's something you should view favorably. And it's kind of a constraint on management, right? Remember, one of the bad signs in companies is doing big empire building M&A, spending a ton of money on CapEx. So all of those like over expansion signals are restrained if you have the discipline to just keep giving money back to shareholders, right? And so we far prefer to see companies that are more conservative in their use of capital, and anytime they're in doubt about what to do, give the money back to the shareholders. Now, the other events that we can keep an eye on, which are scrutinized heavily in the markets, is analyst revisions. So this is looking at sell-side analysts that obviously cover most of the companies in the market, looking at their revisions. And somewhat surprisingly, there's still some alpha in that, particularly on the downside. So what that means is, if sell-side analysts downgrade a company or upgrade a company, directionally they do have a little bit of an edge, and we should pay some attention to that. The magnitude of the alpha, again, is not huge. You're talking about, 50 to 150 basis points on the long side, and maybe a bit more than that on the short side. So there's something there in and of itself. It's not going to be enough to hang an investment strategy on. But, at the margin, if the analyst revisions are pointing in one direction or the other, you should pay a little bit of attention to that. So we shouldn't disregard what all the analysts covering the company think about it. Although it's not one of the largest alpha sources anymore, it does still have some directional efficacy. One of the other events that we want to keep an eye on is actually earnings surprises. That is, did the company beat or miss analyst expectations going into the event, right? So if you beat analyst expectations, actually that has been worth something thereafter, maybe about 150 basis points on the long side and something similar on the short side. So somewhat surprisingly, even though markets are fairly efficient these days, if you do surprise, not all of that surprise is immediately impounded in the share price. So there is some drift in the direction of the surprise thereafter. So it hasn't completely been arbitraged out. You should actually pay attention to what goes on in earnings season. Just notice the magnitude of these returns. So they're not massive. You're talking about, again, like 50 to 150 basis points. A lot of the other factors we've seen are much bigger than that, sometimes by 2 or 3 times. So when you look at how much time in our industry is spent on earnings season, I think this is saying perhaps some of that time could be redeployed in other directions because while this matters, it's not as decisive as perhaps it was back in the olden days. The other signal or event that is kind of useful is watching what analysts do to their forecast. So this is looking at analyst earnings revisions. So for all the sell side analysts that cover the company, did their revisions go up or down after something happened to the company or they met with management or whatever? And again, there's some alpha here, and in fact, this is a bit bigger than earnings surprises. So companies that have been upgraded by analysts, the most have outperformed by maybe 3 percentage points per year, and those that have been downgraded have underperformed. So we should pay some attention to what the analysts are up to, right? On average, they do have a little bit of an edge, and it's worth impounding some of that into our stock picking. The other thing that sometimes I think gets dismissed as black magic is technical indicators. It turns out that technical indicators do have some efficacy, and we use technical indicators here at Empirical, not as a major part of what we do, but it's another thing that's worth keeping an eye on. And some of the indicators that we look at are shown here in the footnote. Now, at the bottom here, it's things like RSI, stochastic oscillator, Bollinger Bands, and MACD. And all of those can be helpful at extremes. So we have a composite technical indicator here, and you can see that that has produced some alpha as well. So I don't think you should be completely dismissive of technicals. Fundamentals, we think, are what generally drive returns over the long run. But when the technical signals are particularly stretched, that is worth paying attention to. So those are some of the events that we keep an eye on here at Empirical. And again, the ultimate goal is you want kind of a screen that captures all of these events. You can see at a glance if one of these events has happened to your company, and at the back of your mind, okay, if I got a new CEO, that's historically been worth 1.4 percentage points of alpha that I wouldn't have otherwise had on average, right? So it's not telling us that that is the stock we want to buy, but it just tells you something about, again, the table odds you're facing. So these events, I highly recommend keeping an eye on them. Let's turn now to timing. This module, as I mentioned up front, is quite important. Knowing when to use which tool really matters. There are some tools that are really good at certain points in the market cycle or economic cycle and don't work in other points. And so we want to understand when should we use what. And we want to know that so that when something happens, we can pull out the right tools out of our toolbox and get to work. So let's unpack that. One of the most useful tools for determining when you should use factors is what we call the valuation spread. Now, the valuation spread at a high level is the spread or range of valuations across all the stocks in the market, right? So sometimes you're going to have a really wide spread. Some stocks are going to be really expensive on various valuation measures, and some stocks are going to be really cheap. Other times, they're all going to be kind of similarly priced and you have a narrow spread. Now, what I've got in this chart is the US valuation spread going back to 1926. So we've got almost 100 years of data to look at here. Now, it's a little bit hard to see on the chart, but if you cast your eye to the last gray bar, which is the pandemic recession, the valuation spread in the US spiked up to 4.5 standard deviations above its long-run average on March 18th of 2020. So that was early in the pandemic. That day the market was in free fall. I think the S&P was down like 7 or 8% that day. So it was, pretty bleak, panic stations, right? Nobody knew what the future held. The pandemic was rapidly engulfing the world. Most risk assets were in free fall. And so you've got this enormous valuation spread, because some stocks, more defensive, stay at home, virtual stocks, were trading at much higher valuations in all the real world businesses that were directly affected, like airlines, cruise lines, restaurants, retail. So you've got this enormous spread. So you can think of the valuation spread as the risk premium that you're earning to be contrarian. Right? It's telling me how much fear is there in the market, but it's also telling me how much am I getting paid if I go and run towards danger. You can think of it as like the equity market equivalent of a credit spread, right? The wider the spread is, the more risk aversion there is, but also potentially the bigger opportunity. So we're willing to take on risk, but only if we're being paid to do so. So think of the valuation spread as telling me how much am I being paid to be contrarian, to buy whatever is scary at that point. The reason this thing matters is it's very helpful in telling us what kind of toolbox we want to bring to work every day. And we don't just calculate these these spreads at the market level. We also calculate them at the sector level, as you can see here. So currently, the valuation spreads across the sectors are fairly contained. But if you roll the clock back to mid-March of 2020, basically all of these gray bars would be close to 100%. Meaning you have the widest disparity in valuations across all the stocks in that sector that you've ever seen. When you've got a wide spread, historically that has been good for value stocks. Because what tends to happen is markets over extrapolate whatever the cause of the fear is, right? So in a global pandemic, you immediately leap to the worst case. Economies are going to collapse, everybody's going to get wiped out. It's pretty terrible, right? So when you're in that panic phase, the human reaction is to run away from danger, right? Just get me out, sell first, ask questions later. But what it means is investors tend to overreact to how bad things actually are. Luckily, as humans, we generally do something about it, right? The government steps in with fiscal stimulus, scientific ingenuity comes up with vaccines in record time. When things are that bad, you're not just going to sit around and wait for the world to end. We're going to try to do something about it. And so what ends up happening is those valuation spreads can often contract quicker than what you think, right? Because you've priced in the worst case. And if the world doesn't end, that's not so bad. And those spreads come back. So you're betting on kind of this mean reversion in the spread, which means that the value stocks, whatever was scary, is getting re-rated. And that's historically what we've seen. So what I'm looking at here is the performance of value stocks in the 12 months after the value spread hits these various levels. So remember, in March of 2020, you were well above 2 standard deviations on the value spread in the right-hand bar here. And after that, in the next 12 months, value stocks outperformed by like 28 percentage points. Conversely, when you're starting with a really narrow valuation spread, you don't have much potential energy and value, right? The value stocks are priced pretty much the same as all the other stocks, and so there's just not that much upside. So what it's telling us is when you want to make a big value bet is when there's stress in the system, when things are panicky, blood in the water, when everybody's selling first and asking questions later. It's what Warren Buffett says, right? You want to be greedy when everybody else is fearful. The valuation spread is a measure of how fearful everybody is. So in our framework, when do I want to use value factors? When everybody's panicking. And we need that discipline as humans, right? Because we're like every other human. We're hardwired to run away from danger. But investing, you want to do the opposite. You want to run headlong into danger. You want to run into the burning building when you're being paid a lot to do that. So the valuation spread is going to tell us how much we're being paid to do that. On the other hand, there's other factors that are the opposite. Buying growth stocks is a terrible idea when the value spread is wide, right? Because the opportunity is in whatever's at the heart of the storm. Usually the growth stocks are kind of the safer ones, right? So in the pandemic, it was a lot of, the stay-at-home kind of techie plays, right? Like the Pelotons of the world that did well in that setting. And so when you've got a wide spread, you want to do the opposite. You don't want to buy growth stocks. You want to buy the beaten down stuff. So historically, starting at a 2 standard deviation or higher value spread, like again, we had in March of 2020, growth stocks have underperformed by like 14, 15 percentage points in the year after that. So in any kind of factor investing toolbox, you kind of want underneath the hood some kind of dial that's going to upweight valuation factors whenever the value spread is wide and downweight growth. Otherwise, you might get stuck using a growth factor at precisely the wrong time or vice versa. So knowing when to use these things is really important. Now, there are some factors that are a little bit more all-weather. And one of those factors we've talked about already in previous modules, that is free cash flow margins. Buying high-margin businesses has been pretty good in all but the widest valuation spread settings. So it's more consistent in different states of the world than some of these other factors that we've looked at. We still want some reference to where value spreads are because we don't really want to put a huge weight on free cash flow margins when spreads are super wide. But most of the time you can get away with using this factor. It's another reason why we like it as part of our toolbox. But we still need to keep one eye on when we should use it. What's really interesting about the market is everybody pays a lot of attention to macro indicators, but we've always found they're not as useful in timing when to use different factors as market-derived indicators are. So the valuation spreads derived from the market, right? It's the market expressing how much fear they feel. We could use something else like maybe the yield curve, which is a traditional factor to look at from a macro perspective. And that has had some efficacy in predicting what we should use. For example, when the yield curve is inverted, as it has been recently, growth stocks generally do better, as they have recently. And when the yield curve is very upward sloping, which generally suggests you think, there's stronger economic growth in the future, rates are going to go up to reflect that. Generally, value stocks have done better. They're typically more cyclical businesses. So, there are some relationships that you can exploit a little bit based on the macro setting, but they're just not as strong as what you get from some of these things like the valuation spread. The other thing that's worth keeping an eye on is some factors have autocorrelation, which is just a fancy way of saying if they're working, they tend to keep working. And the classic example, almost by definition, is momentum. Generally, if historic momentum returns are good over the last 3 months, the best bet is that they keep working. So momentum has momentum, if you will. And so we can take that into account as well. So all of these are ways that we can kind of shape which tools we use at each point in time. Now, in our work here at Empirical, we can take all of these ideas and try to get a little bit more sophisticated about it, but it's basically at its root this same idea. We want to build some kind of indicator that tells us when to use what. And here at Empirical, the indicator we've been using for 15 years now is what we call our regime indicator. And it's basically just a fancy way of taking into account all the things I just showed you. So the biggest part of this indicator is the level and direction of valuation spreads. You want to bet on value factors when the spread is wide, but starting to come back down. Conversely, when the spread's narrow, that's when you want to make a growth bet. So that's a pretty important factor timing tool. We talked about the autocorrelation or inertia in some of these things. That's captured at the bottom of this pie. If price momentum is working, for example, we should probably assume it'll continue to work. That's generally better for growth type stocks. We talked about the yield curve, for example. So I won't go through all of the factors here, but I just want to illustrate that what we've talked about here, these are the basic building blocks for a much more sophisticated way of trying to identify what state of the world we're in that's been used in real time by our clients for more than a decade. And it's been very helpful in our own modeling, because what we do is we vary the weights on our factors depending on what this regime indicator says. Here's what the output of it looks like. So this is what you're ultimately trying to build up to. In our framework, we basically divide the world up into 5 states of the world, or regimes. One is what we would call a value-driven market. That's when the value spread is wide, people are panicking. The momentum in some of these factors has crashed and everything's collapsing. That's when we want to make a big value bet. A 5 on this indicator would be a growth-driven environment. That's when valuation spreads are narrow, there's reasonable momentum, good is good, and you want to just kind of backing the winners. That would be a more momentum growth-driven market. Just so happens right now we're in the middle of the road in a neutral setting, but that can obviously change. So it's really helpful to have this framework on top of your factors, so that underneath the hood, when the conditions in the market change, you're emphasizing the tools that have historically been helpful in that state of the world. And this is, I think, really important and becoming more important. It's becoming harder and harder to find factors that consistently work at all times. So you've got to bet on something. And one of the things that we've chosen to bet on is having some expertise in knowing when to use each factor. And this is built into all of our stock selection models. In the final module, I want to put everything we've talked about together in a real world model. And what I'm going to do is talk a little bit about trying to predict losers or finding stocks that are poised to fail. When I say fail, I just mean companies that are expected to underperform over the next 6 to 12 months. I want to do this for 2 reasons. One, we've found over multiple decades now that predicting losers is the best use case for quant tools. There's a lot of commonalities in stocks that lose, more so than stocks that win. stocks can win for lots of different reasons, and often those reasons are quite idiosyncratic, right? It might be like you invented the first iPhone, or you built the first electric car at scale. Very hard for a quant model to pick up on those kind of one-off inventions that often lead to long-term success. But stocks that fail, they have a very consistent fingerprint that you see time and time again. And so what is quant good at? It's good at quantifying that fingerprint. What should we watch out for? Here's the set of stocks with the set of characteristics that has consistently led to underperformance. So this is also going to be a good a summary of everything we've talked about, because we're going to put all of these ideas together and use them all in an actual model. So let's dive in here. The first warning sign: you don't produce gross cash flows. This sounds ridiculously simple, right? But if you just look at the statistical odds of companies with negative gross cash flows on a trailing quarter basis, it's terrible. On average, companies that don't make money have underperformed by 8 to 10 percentage points per year. And that's been true in every single decade since the 1960s. So as a starting point, the market tends to overestimate companies that don't make money, how successful they're going to be in the future, right? So a lot of these companies are, growth companies, and they're just starting up. And of course, they're not profitable yet, right? And that's fine. But if you just consistently lean into these companies, it's a very tough headwind to overcome. So as a starting point, not making money, that's a pretty good warning flag. It's not going to be sufficient. Of course, there's plenty of companies like Amazon or Tesla that didn't make money for a long time and became successful, but there's a lot more companies that didn't make money and never found a way to make money. And so a basket of money losers is not a good bet on average. That's been particularly true, I think, recently. So what I'm looking at here is just what percent of companies don't have gross cash flows or have negative gross cash flows. You can see on the right that really spiked up post-pandemic. We had a lot of kind of junky companies, SPACs, a lot of these kind of, pandemic darling startups like Peloton that just didn't make money through that boom time and then it's not obvious how they're going to make money going forward. So you had a lot of money losers. And historically, when you see a lot of money losers across the market, that's an extra warning sign, right? It's telling us that the market is maybe getting a little bit carried away. It's getting frothy. Everybody's enamored with all these money losers. Nobody thinks that profitability matters anymore. We had sort of a situation like that in late 20 into 21. The meme stock era wasn't that long ago. SPACs, all of that. A lot of just really atrocious companies that didn't have a path to profitability. And it sounds easy to say now, but that's tough to say back in that time when those companies were ripping, right? And so again, a quant model is going to give us some discipline to avoid those companies, even when that's really painful because you feel the FOMO that everyone else feels. But that's come back a bit now, which is a better starting point. But we had a couple of crazy years right after the pandemic where there were an awful lot of money losers in the market. Another factor which we want to watch out for when we're trying to identify losers is a kind of wonky quantity that we call arbitrage risk. Now, arbitrage risk is just an academic name for stock-specific volatility. So if you look at a stock and you look at its daily stock returns, arbitrage risk or stock-specific vol, all it's doing is capturing how much of those returns can be explained by the market's move and the stock's beta. So kind of a boring, well-behaved stock, let's say it's got a beta of 1.2. If the market's up 1% that day, probably the stock should be up around 1.2%, just the market's move times its beta, right? If it's not, then something else is going on. Maybe there's some stock-specific news out. Maybe the company just announced earnings, something like that. So if you have high arbitrage risk or stock-specific risk, it just means the stock is doing its own thing. It's not moving with the tide of the market. Now, doing your own thing as a stock is not good or bad, right? Like I said, it could be a good thing. Maybe you just beat earnings, so you're up a lot when the market's down, or vice versa. Maybe you had a profit warning and you're down in an up market, right? That just means it could be good or bad if something's going on in the stock. It turns out, though, on average, high arbitrage risk is bad. As you can see here, this is stocks with high arbitrage risk. They pretty consistently underperformed. It is particularly bad in companies that are starting at high valuations. So when you've got like a highly valued, story-driven stock that everybody believes in, you don't want high arbitrage risk, because that's like the first controversy emerging in the stock. It's kind of like a sign that there is some kind of debate in the company, or you've run into some kind of turbulence. And in one of those stocks, you don't want that. You just want everyone to keep believing it kind of placidly keeps moving. There's no real turbulence in the stock. So this is something to watch out for in conjunction with things like high valuation and inability to make money. When you see that high arbitrage risk, that can be the catalyst you're looking for to say, watch out. So we keep a very close eye on this. Here you can see an interaction that's quite important. If you have negative or low free cash flow margins, which would be the right-hand bar, and also high arbitrage risk, that is an extra bad combination. Those stocks have underperformed almost 10 percentage points per year. So if you're not making money as it is and you start to get this controversy or turbulence, watch out. That's a very bad combination. We call it a toxic couple in our work. Another one that we want to be careful of is something that we call supernova. So a supernova stock is one that's had a few really big jumps on a few days recently. So, you got a stock and it suddenly pops up 20%. Now, if you see a stock that's had a big jump and the longer term price trend, say the last 9 months, is negative, so you've got a stock that's been drifting down over the last 9 months, but recently it's had a big one-day pop, what does that tell you? Is that a turnaround story where it's finally going to break out of its longer term trend? Or is it a false flag or like a head fake? It turns out it's the latter. It's much more likely that the long-term trend carries the day, and you should bet against that company. So one of the things we're looking for in looking for stocks that are at risk of failure is kind of a weak long-term price chart with a few big one-day jumps. It turns out those one-day jumps are not typically sustainable. The longer-term trend was more reflective of what's going on in the company, and you want to take that opportunity to bet against that company. So that's another toxic couple that we're looking for. So a lot of failure modeling is trying to find these combinations that have just been acutely bad for a company's future returns. In this case, in the right-hand bar, you can see that such stocks have underperformed on average by about 14 percentage points per year. Another thing that we want to watch out for when we're modeling failure is the level of shorting in a stock. Now, obviously, we had the meme stock era where the whole point was to bet against the shorts. But actually, if you look at it statistically, even including that period, on average, the shorts do have an edge. Meaning stocks that are heavily shorted have tended to underperform on average. And that's been true even in the 2020s with the high-profile meme stocks. So if you see a stock that has other characteristics of failure and the shorts don't like it, they're heavily shorting it, you should bet with them. You should assume that that makes it more likely to fail. So think of shorts as the smart money, even though I know that's not how they were perceived over the meme stock era. Those were more isolated examples. On average, they do have a small edge. Another thing that you should pay attention to now is the media sentiment surrounding a stock. So one of the things we do is we assess the sentiment of not just the traditional news flow surrounding a company, right? So obviously a company might be, in the New York Times or Bloomberg or on CNBC or whatever, but also social media. And these days, with things like AI and machine learning and natural language processing, you can tease out how positive or negative is the language being used to describe that company. It turns out that does matter. So if you have a company where the media sentiment is starting to turn on it and everybody's saying bad things about the company, on average, that's bad. Those companies have underperformed by about 3 to 4 percentage points per year, as shown in the black bars here. So you want good, favorable media coverage. You don't want bad media coverage. Fairly self-explanatory, but the empirical results are actually reasonably strong, about 3 points in either direction. The other thing that we often get asked when we're thinking about stocks to avoid is, should we avoid crowded names? Now, this is a bit of an interesting one because one way you can measure crowding is just look at how many hedge funds own a stock, right? That's traditionally been thought of as a crowding measure because if they all have to exit or deleverage, it puts a lot of pressure on the stocks. Now, this is not one that hasn't been completely consistent. So over the long run, which is the left-hand bar here, actually having high hedge fund ownership in a stock has been a slight positive for stock returns. Not very big though, so for all intents and purposes, you can say it kind of didn't matter over the long run. What's been interesting is over the last 5 years, high hedge fund ownership has been bad. So this factor, it's not a super strong factor in the sense that we talked about in module one, because it hasn't been that consistent over time, right? You never want to bet on something that kind of flip-flops like what you see here. The better way, I think, to think about crowding is this chart. What I'm looking at here is the forward returns to stocks depending on their, for stocks with high hedge fund ownership. So we're looking at, if I take a basket of stocks that have high hedge fund ownership, how likely are those stocks over the next 12 months to be in each quintile of future returns? And so what this U-shaped pattern is telling us is if you have a stock with high hedge fund ownership, it is more likely over the next 12 months to either end up in the highest quintile of future returns or the lowest quintile. In other words, it's likely to have fat tails going forward. So you can think of crowding or hedge fund ownership as a magnifier of what happens. Hedge funds gravitate towards stocks that might break big one way or the other. And so one thing you know about a company with a lot of hedge fund ownership is something big is probably going to happen. It's either going to go down a lot or up a lot. It's not just going to sit there in the middle. So think of it as kind of a magnifier in both directions. If the stock has other failure characteristics, then that magnification is probably on the downside and you want to be extra careful in that name. And that's what you see here. The other relationship that's worth watching is when you have a stock with high hedge fund ownership and you see that high stock specific volatility, that high arbitrage risk that we talked about, that's another bad combination. When everybody is in the stock, you don't want any kind of controversy. You don't want any uncertainty. Otherwise, there's a risk they might all run for the hills, right? Hedge funds tend to be fairly loss averse and tend to cut their losses pretty quickly. And if everybody does that, that can be pretty detrimental to the stock. So another toxic combination you want to watch out for is high hedge fund ownership and high arbitrage risk. That is a dangerous combo. So again, there's all these different little statistical intersections, if you will, that you want to be careful of when you're building a downside model. So we can take all of these ideas and we can put it into a model. Here at Empirical, we call that our failure model. It's been running for 20 plus years now in live performance. It's the most used model we have by our clients, partly because it has the best track record of any of our models, but also, as I mentioned, predicting losers is easier than predicting winners quantitatively. So I won't take you through all of the individual factors, but the spirit of what we're trying to capture here is if you start in the upper right, first we're looking for valuations. In this case, high valuations are what we're watching out for. Now, that doesn't automatically mean the stock's going to fail, right? A high valuation might mean it's a great company, great growth story, deserves that high valuation. But it's just saying if things go wrong, there's a long way to fall, right? Big expectations are baked into this stock, you better deliver. Then we look at capital deployment, which we've come across before, right? Some of the factors we've talked about in this course are related to capital spending, giving money back to shareholders. So in this context, we're looking for companies that have high valuations where the company is spending a lot of money to keep those valuations up, right? So they're looking for the next leg of growth. They're investing a lot of money to, build new factories, produce more products. Their inventory is expanding aggressively. They're financing all of this growth by raising new debt or equity. Remember, we've talked about all of these factors before. If you see this in conjunction with high valuations, it's kind of giving you this sense that, maybe this company is caught on this treadmill where they're spending more and more money to keep up with the market's expectations. Excuse the pun, but the classic example that the failure model got right in the pandemic was Peloton. It had all of these characteristics, high valuations, was expanding rapidly, inventory increasing. You couldn't get a bike for a while in the pandemic, adding all this new capacity, doing big M&A, trying to go vertical. And so it had some of those characteristics. As that happens, is the earnings quality starting to deteriorate? So it could be your free cash flow margins coming under pressure. Maybe your accounting is starting to look a little bit aggressive. Maybe the language you use in your 10K and Q filings is starting to shift. So those are some signs that, there's cracks appearing. But still, in the right-hand side of that pie, there will still be a lot of great growth stories that have all of those characteristics. What you need is some kind of catalyst that says now is the moment the market changes its mind. And that is the market reaction component in the lower left. So these are the factors some of the factors we just talked about, right? Like arbitrage risk, for example. We talked about technical indicators. We talked about news sentiment. You're looking for shorter term signals that something's changing in the way the market is thinking about that stock. Because when you see those cracks, when you see that turbulence in a high flying stock that's spending a ton of money and the fundamentals are starting to roll over, that is more often bad than good. So that's kind of the core of the failure model, is those high expectations, caught spending a ton of money trying to justify those expectations. Things are starting to crack, but then the market also decides to turn on the stock. That's often when a stock will move on to our failure model. So all of this looks a little bit complicated, but it's really just using all of these basic ideas that we've talked about in this course, right? You find some factors that are consistent. You think about putting those factors together in combinations that are better than the sum of the parts. Sitting over the top of this, which you can't see here, is what we talked about in the previous module, timing things. So valuation, for example, we talked about it'll matter more when the valuation spread is wide. It'll matter less when the valuation spread is narrow. So behind the scenes, the size of these slices changes depending on the state of the world that we're in. And so all of these things come together into this model, but they're just the same building blocks that we've talked about deployed in a more sophisticated way. The performance of this model has been good. So here's the performance of what we would call failure candidates, which are stocks in the worst decile of the model. And I'm looking at large and small caps here in gray and black respectively. And, if we look at, say, year to date being through mid-August when we're recording this, the failure stocks have underperformed the market by about 10 percentage points per year. Over the long run, in the live performance of the model, which is shown on the far right, we've also generated about 10 points of underperformance per year. We had a couple of really great years right after the pandemic when a lot of those money losers collapsed. So 2021 and 22 were two of the best years in the model. But on average, we'd expect the failure stocks to underperform by about 10 points per year. And sitting behind this, the win rate, or in this case, the lose rate, is about 60-40. So about 60% of the names on the failure model should underperform over the next 12 months if live performance is any guide. That's a pretty good statistical edge. Again, it doesn't sound like much, but if you're flipping a slightly biased coin that's 60-40 in your favor lots of times, that is going to cumulatively add up. And that's kind of what we are capturing here. So again, the whole point of these quant tools is not to become like a black box quant investor. It's to put some numbers, some table odds around what you're doing. Try to pick your stocks from a statistically advantaged part of the universe. Try to avoid a statistically disadvantaged part of the universe. A 10-point edge added on to whatever your own stock picking skill is, that is going to set you up for success if you apply it consistently. Here's what the output of this model looks like, just to give you a flavor for it and kind of what our clients would see in real time. They take a feed of this. I won't go through all the details now, particularly because this is recorded. These stocks will change, but it just gives you a sense for like what the actual toolbox might look like, right? I'm interested in which stocks are screening as failure candidates and why are they screening as failure candidates? How do they score on these different building blocks that we've talked about? So with that, thank you very much for your time. Really appreciate it. And if you have any questions, please reach out.